Foreign exchange risk and how to manage foreign exchange risk. Welcome to the Risk Management of Everything channel. On this channel, you will find videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, please consider subscribing to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video explains the meaning of foreign exchange risk and how to manage foreign exchange risk. It discusses the meaning of currency risk and the management of currency risk. In this video, you will understand the meaning of foreign exchange risk/currency risk, understand foreign exchange risk, sources of foreign exchange risk, types of foreign exchange risk examples, foreign exchange risk management, currency risk management, types of forex market, methods of measuring foreign exchange risk, strategies for managing foreign exchange risks, foreign exchange risk management process, and foreign currency risk management tools. Now, let us start. What is foreign exchange risk? Foreign exchange risk, also known as currency risk, FX risk and exchange rate risk, refers to the losses that an international financial transaction may incur due to currency fluctuations. Currency risk, commonly referred to as exchange rate risk, arises from the change in the price of one currency in relation to another. Currency risk entails the possibility that an investment's value may decrease due to changes in the relative value of the involved currencies. Foreign exchange risk should be managed where fluctuations in exchange rates impact the profitability of the business. In a business where the core operations are other than financial services, the risk should be managed in such a way that the focus of the business is on providing the core goods or services without exposing the business to financial risks. Investors may experience jurisdiction risk in the form of foreign exchange risk. Investors or companies that have assets or business operations across national borders are exposed to currency risk that may create unpredictable profits and losses. Many institutional investors, such as hedge funds and mutual funds, and multinational corporations use forex, futures, options contracts, or other derivatives to hedge the risk. Understanding foreign exchange risk. Firms and individuals that operate in overseas markets are exposed to currency risk. Foreign exchange risk arises when a company engages in financial transactions denominated in a currency other than the currency where that company is based. Any appreciation/depreciation of the base currency or the depreciation/appreciation of the denominated currency will affect the cash flows emanating from that transaction. Foreign exchange risk can also affect investors, who trade in international markets, and businesses engaged in the import/export of products or services to multiple countries. The proceeds of a closed trade, whether it is a profit or loss, will be denominated in the foreign currency and will need to be converted back to the investor's base currency. Fluctuations in the exchange rate could adversely affect this conversion, resulting in a lower than expected amount. An import/export business exposes itself to foreign exchange risk by having account payables and receivables affected by currency exchange rates. This risk originates when a contract between two parties specifies exact prices for goods or services, as well as delivery dates. If a currency's value fluctuates between when the contract is signed and the delivery date, it could cause a loss for one of the parties. Sources of foreign exchange risk. Foreign exchange risk for a business can arise from a number of sources, including where the business imports or exports, where other costs, such as capital expenditure, are denominated in foreign currency, where revenue from exports is received in foreign currency, where other income, such as royalties, interest, dividends etc., is received in foreign currency, where the business's loans are denominated, and therefore payable, in foreign currency, and where the business has offshore assets such as operations or subsidiaries that are valued in a foreign currency, or foreign currency deposits. Impact of movements in foreign exchange rates on businesses. Here are the impacts of movements, falling and rising, of foreign exchange rates on businesses. A falling domestic exchange rate can have the following effects. It can increase costs for importers, thus potentially reducing their profitability. This can lead to decreased dividends, which in turn can lead to a fall in the market value of the business. Domestically produced products can become more competitive against imported products. It can increase the cost of capital expenditure where such expenditure requires, for example, importation of capital equipment. The cost of servicing foreign currency debt increases. Exporters may become more competitive in terms of costs, potentially increasing their market share and profitability. The business could become a more attractive investment proposition for foreign investors, and for the business, the cost of investing overseas could increase. A rising domestic exchange rate can have the following effects. Exports can be less competitive, thus reducing the profitability of exporters. This can lead to decreased dividends, which in turn can lead to a fall in the market value of the business. It can decrease the value of an investment in foreign subsidiaries and monetary assets, when translating the value of such assets into the domestic currency. Foreign currency income from investments, such as foreign currency dividends, when translated into the domestic currency may decrease. The cost of foreign inputs may decrease, thus giving importers a competitive advantage over domestic producers. The value of foreign currency liabilities will fall. Hence, the cost of servicing these liabilities decreases. The cost of capital expenditure will decrease. For instance, if it is for the importation of capital equipment, the business potentially becomes a less attractive investment proposition for foreign investors, and the cost of investing overseas may decrease. Types of foreign exchange risk. There are three types of foreign exchange risk: transaction risk, translation risk and economic risk. 1. Transaction risk. Transaction risk arises when a company is importing or exporting. This is the risk that a company faces when it's buying a product from a company located in another country. The price of the product will be denominated in the selling company's currency. If the selling company's currency were to appreciate versus the buying company's currency, then the company doing the buying will have to make a larger payment in its base currency to meet the contracted price. If the exchange rate moves between agreeing on the contract in a foreign currency and paying or receiving the cash, the amount of home currency paid or received will alter, making those future cash flows uncertain. For example, in June a UK company agrees to sell an export to Australia for $100,000 Australian dollar, payable in 3 months. The exchange rate at the date of the contract is Australian dollar/pound 1.80, so the company is expecting to receive 100,000 1.8 equals £55,556. If, however, the Australian dollar weakened over the 3 months to become worth only Australian dollar/pound 2.00, then the amount received would be worth only £50,000. Of course, if the Australian dollar strengthened over the 3 months, more than £55,556 would be received. It is important to note that transaction risk management is not mainly concerned with achieving the most favorable cash flow, it is mainly aimed at achieving a definite cash flow. Only then can proper planning be undertaken. 2. Translation risk. A parent company owning a subsidiary in another country could face losses when the subsidiary's financial statements, which will be denominated in that country's currency, have to be translated back to the parent company's currency. Translation risk affects companies with foreign subsidiaries. If the subsidiary is in a country whose currency weakens, the subsidiary's assets will be less valuable in the consolidated accounts. Usually, this effect is of little real importance to the holding company because it does not affect its day-to-day cash flows. However, it would be important if the holding company wanted to sell the subsidiary and remit the proceeds. It also becomes important if the subsidiary pays dividends. However, the term translation risk is usually reserved for consolidation effects. Foreign exchange translation risk can be partially overcome by funding a foreign subsidiary using a foreign loan. For example, take a U.S. subsidiary that has been set up by its holding company providing equity finance. Its statement of financial position would look something like this. 3. Economic or operating risk, also called forecast risk, refers to when a company's market value is continuously impacted by unavoidable exposure to currency fluctuations. The source of economic risk is the change in the competitive strength of imports and exports. For example, if a company is exporting, let's say from the UK to a Eurozone country, and the euro weakens from say euro/pound 1.1 to euro/pound 1.3, getting more euros per pound sterling implies that the euro is less valuable, so weaker. Any exports from the UK will be more expensive when priced in euros. So goods, where the UK price is £100, will cost €130 instead of €110, making those goods less competitive in the European market. Similarly, goods imported from Europe will be cheaper in sterling than they had been, so those goods will have become more competitive in the UK market. Note that a company can, therefore, experience economic risk even if it has no overt dealings with overseas countries. If competing imports could become cheaper, you are suffering risk arising from currency rate movements. Doing something to mitigate economic risk can be difficult, especially for small companies with limited international dealings. In general, the following two approaches might be helpful to mitigate foreign exchange economic risk. 1. Try to export or import from more than one currency zone and hope that the zones don't all move together, or if they do, at least to the same extent. For example, over the 6 months, the 14th of January 2010 to the 14th of June 2010, the euro/U.S. dollar exchange rate moved from about euro 0.6867 US dollars to euro 0.8164 US dollars. This means that the euro had weakened relative to the US dollar, or the US dollar strengthened relative to the euro, by 19%. This made it less competitive for US manufacturers to export to a Eurozone country. If, in the same period, the pound/U.S. dollar exchange rate moved from pound/0.6263 US dollars to pound/0.6783 US dollars, a strengthening of the US dollar relative to pound of only about 8%. Trade from the US to the UK would not have been so badly affected. 2. Make your goods in the country you sell them. Although raw materials might still be imported and affected by exchange rates, other expenses, such as wages, are in the local currency and not subject to exchange rate movements. Foreign exchange risk examples. If you think currency and exchange rates are only a concern for bankers, it's time to think again. Currency risks affect all international companies. For international businesses with significant volumes of cross-border transactions, the management of currency risk is an essential task for the Treasury Department. Given that they have substantial costs and/or revenues in foreign currencies, these companies are exposed to serious setbacks if the exchange rate moves against them. Example 1. An American liquor company signs a contract to buy 100 cases of wine from a French retailer for €50 per case, or €5,000 total, with payment due at the time of delivery. The American company agrees to this contract at a time when the euro and the US dollar are of equal value, so €1 equals $1. Thus, the American company expects that when they accept delivery of the wine, they will be obligated to pay the agreed-upon amount of €5,000, which at the time of the sale was $5,000. It will, however, take a few months for delivery of the wine. In the meantime, due to unforeseen circumstances, the value of the US dollar depreciates versus the euro to where at the time of delivery €1 equals $1.10. The contracted price is still €5,000, but now the US dollar amount is $5,500, which is the amount that the American liquor company will have to pay. Example 2. Let us think about a European producer that imports components from an Asian provider 4 times a year. Each time, the European company negotiates a price in US dollars with the provider, signs a contract when an agreement has been reached and receives an invoice from the provider 3 months later when the goods have been delivered. To safeguard its profit margins, this producer needs to avoid an increase in its costs in the event that the euro depreciates against the dollar in the meantime. In this case, a simple currency management strategy would be to purchase a euro to US dollar forward contract to cover the exposure from the moment of the agreement of the contract to the actual payment date. This would allow the company to lock in the exchange rate from the contract signature to the payment date. It is worthwhile to emphasize that there are businesses with more complex foreign exchange management needs, either because they have higher transaction volumes or because they work with a larger number of currencies. In these cases, they can benefit from automating part of the management process to improve process efficiency. Types of forex market. There are 3 different types of forex market. 1. Spot market. The physical exchange of a currency pair takes place at the exact point the trade is settled, that is, on the spot. 2. Forward market. A contract is agreed to buy or sell a set amount of a currency at a specified price, at a set date in the future or within a range of future dates. 3. Futures market. A contract is agreed to buy or sell a set amount of a currency at a set price and date in the future. Unlike forwards, a futures contract is legally binding. Foreign exchange risk management. Foreign currency risk management or simply currency risk management are the terms to describe the strategies that help a company or investor to protect their cash flows, assets or liabilities from the impact of adverse fluctuations of the exchange rate. Companies that are subject to foreign exchange risk can implement hedging strategies to mitigate that risk. This usually involves forward contracts, options, and other exotic financial products and, if done properly, can protect the company from unwanted foreign exchange moves. If you think currency and exchange rates are something only bankers have to be concerned with, think again. Many businesses are exposed to currency risk, whether they realize it or not. With the recent wild swings in global currencies, the exchange rate risk is back on the agenda for companies with customers, suppliers or production in other countries. For example, the spread of coronavirus brought dramatic fluctuations in currency rates. Strict regulations to contain the outbreak put the brakes on the global economy, triggering a matching fall in oil prices and stock markets. The market is seeking safe havens, moving towards the Japanese yen, US dollar and Swiss franc. Smaller currencies and commodity currencies have suffered, including Norwegian krona, Swedish krona, Australian dollar, New Zealand dollar and emerging market currencies, though some of the falls in value has reversed subsequently. The fact is that if you run a business that earns revenues abroad or has costs in other countries, you are likely to be exposed to currency risk. Events outside of your control could reduce your revenues and increase your costs. So how big is the problem of managing currency risks? In a survey of 200 chief financial officers and nearly 300 treasurers conducted by HSBC and FT Remark, 70% of chief financial officers, CFOs, said that their company suffered reduced earnings in the prior 2 years due to avoidable, unhedged FX risk. 58% of CFOs in larger businesses said that FX risk management is one of the 2 risks that currently occupy the largest proportion of their time, and 51% said that FX is the risk that their organization is least well equipped to deal with. Currency fluctuations are also a threat to small and mid-sized businesses, but according to Nordea's study done in late 2020, too many SMEs underestimate their currency risks. Businesses with turnovers above €2 and a fair level of imports and exports say that they've experienced unexpected financial losses caused by currency fluctuations during the COVID-19 pandemic. However, close to half of the SMEs have not protected themselves against this, and the survey indicates that the biggest barriers for managing the risk have to do with lack of time and know-how. Effective management of currency risk is beneficial to international businesses. Such benefits include 1. Protection for the business cash flow and profit margins. 2. Improved financial forecasting and budgeting. 3. A better understanding of how fluctuations in currencies affect the balance sheet of an organization. 4. Increased a firm's borrowing capacity. Methods of measuring foreign exchange risk. There are many ways to measure foreign exchange risk, ranging from simple to complex. Sophisticated measures such as value at risk may be mathematically complex and require significant computing power. Here are some ways of measuring foreign exchange risk which can be applied and understood by most businesses. 1. Register of foreign currency exposures. A very simple method is to maintain a register of exposures and their associated foreign exchange hedges. Basically, the details of each hedge are recorded against its relevant exposure. This type of approach may also assist with compliance with accounting standards for hedging, such as USP 139, Financial Instruments, Recognition and Measurement. 2. Table of projected foreign currency cash flows. Where the business both pays and receives foreign currency, it will be necessary to measure the net surplus or deficit for each currency. This can be done by projecting foreign currency cash flows. This not only indicates whether the business has a surplus or is short of a particular currency, but also the timing of currency flows. 3. Sensitivity analysis. A further extension of the previous measure is to undertake sensitivity analysis to measure the potential impact on the business of an adverse movement in exchange rates. This may be done by choosing arbitrary movements in exchange rates or by basing exchange rate movements on past history. For example, the business may wish to know how much it will gain or lose for a given change in exchange rates. Where commodities are involved, businesses sometimes develop a matrix showing the combined result of currency and commodity price movements. 4. Value at risk. Some businesses, particularly financial institutions, use a probability approach when undertaking sensitivity analysis. This is known as value at risk. While it is useful to know the potential impact of a given change in exchange rates, say a USD 1 cent movement, the question will arise, how often does this happen? Accordingly, we can do a sensitivity analysis using past price history and apply it to the current position. Then, given the business's current position, and based on exchange rates observed over the last 2 years, it can be 99% confident that it will not lose more than a certain amount, given a certain movement in exchange rates. In effect, the business has used actual rate history to model the potential impact of exchange rate movements on its foreign currency exposures. Strategies for managing foreign exchange risks. Understanding where and how currency fluctuations affect a company's cash flow is not straightforward. Many different factors, from macroeconomic trends to competitive behavior within market segments, determine how currency rates affect cash flows in a given business. Here are 5 strategies for managing foreign exchange risks. Step 1. Review your operating cycle. Review your business operating cycle to learn where FX risk exists. This will help you determine your profit margin sensitivity to currency fluctuations. Step 2. Accept that you have unique currency flows. Every business is unique and that is reflected in your currency flows, but also in the structure of your assets and liabilities. It is key to understand that currency fluctuations may have an impact and the decision to hedge or not is not as simple as a roll of the dice. Step 3. Decide what rules you want to apply to your FX risk management, and stick to them. An effective FX policy begins with a clear understanding of the company's financial objectives, and the potential effect the changes in FX rates might have on them. If the operative cash inflows and outflows are in different currencies, changes in FX rates might jeopardize the company's earnings before interest, taxes, depreciation and amortization, EBITDA, target. If the assets and liabilities are in different currencies, remeasuring those assets with new FX rates might jeopardize the P&L bottom line or the equity ratio targets. The FX risk management policy ensures that whatever the financial objectives are, such FX risks that could jeopardize those objectives are monitored and mitigated, systematically. Step 4. Manage your exposure to currency risk. Especially when it comes to physical products, there is a time lag between making business decisions and seeing the effects of those decisions on the company's bank account. During that time gap, the purchase and sales orders are negotiated, materials shipped around the world and goods manufactured, stored and delivered. In parallel to that physical process, invoices are being sent, reviewed, approved and eventually paid. Meanwhile, currencies are appreciating and depreciating. If the material and manufacturing costs are in a different currency to the sales receipts, those fluctuations in FX rates can easily wipe away the sales margins the company used as the basis for its original decision-making. Financial instruments can help mitigate this uncertainty that jeopardizes the company's financial objectives. This is called hedging, and it ensures that the FX rates affecting the company's bank account balances are not too different from those used in its decision-making. Step 5. Automate FX handling to free up your time. Small businesses, as well as large corporates, can all benefit from automating their FX handling. Engaging suitable FX solution can help businesses to free up resources, eliminate manual tasks and minimize operational risk and human errors. Foreign exchange risk management process. Like all risks, foreign exchange, FX, risk is managed using the standard risk management process, which looks something like this for FX. 1. Identify FX risks, gather underlying exposures from cash flow forecasts. Once the policy has been set, which is normally an infrequent activity, treasuries need to identify the FX exposures that must be hedged. This is the most critical part of FX risk management. Inaccurate exposure data will lead to wrong hedging, which will increase, rather than reduce, volatility. FX exposures are derived from FX cash flow forecasts. Cash flow forecasting is the foundational requirement for all treasury operations. Treasury cannot be managed effectively and safely without cash flow forecasts. 2. Analyze FX risks, determine value at risk or other metrics of FX exposures. This analysis will form the basis for FX risk management evaluation and must be specified precisely in the FX policy. FX risk, both before and after treatment or hedging, also known as gross and net exposures, is commonly analyzed in the following ways. 1. Notional exposure. This refers to the notional amount of the currency exposure defined as forecast currency inflows fewer currency outflows. Gross notional exposure excludes hedge transactions, whereas net notional exposure includes hedge transactions. These are often translated into the base or functional currency for ease of reading, but given that these are FX exposures, the choice of FX rates for such translation may have a big impact on the perceived exposure. 2. Mark-to-market. The notional currency exposure is translated at the relevant forward rates for the cash flow dates to determine their current market value in base currency. This can be done for gross and or net exposures, and this is often compared with the mark-to-market at the time the exposures were fixed, created, or known, to produce the mark-to-market profit or loss, also known as unrealized gains or losses. 3. Value at risk, VaR. This refers to the value across the portfolio of FX exposures by applying the historical volatility and correlations between currencies, and it represents the maximum loss of the FX exposure portfolio within a certain unwinding period, typically 24 hours or 1 week, and with a certain statistical probability, typically 99% but sometimes 95%. 4. Stress testing. As VaR typically only uses 12 months of FX rates, and extreme FX rate movements often occur at longer intervals than 1 year, it is good practice to stress test the FX exposure portfolio, sometimes gross and always net, against worst-case rates. These can be the worst rates observed over decades or arbitrary extreme rate changes such as 10% for each and 20% for others, or larger percentages at management's discretion. 3. Treat or manage FX risks, hedge with forwards, or options and combined strategies. Treating FX risk is normally achieved with some form of hedging. Commercial, non-financial, businesses typically use some or a mix of the following forms. 1. Natural hedging. This means buying in the same currency as sales are in. Although this sounds like an easy solution, it is normally not effective because suppliers and customers may price the FX risk result for themselves higher than the business itself. Natural hedging is often inflexible because the required commercial agreements are typically harder to change than buying and selling currencies forward. 2. Loan hedging. It is possible to hedge currency sales, a future cash inflow, by borrowing in the currency of the sales. Repayment of the loan is considered to be a future cash outflow, and to deposit purchase currency for the opposite reason. In practice, access to sufficient credit lines and the large loan-to-deposit spread makes this an expensive way to hedge. It may make sense where funding is anyway needed and a currency loan can hedge for recurring business. This can also be useful where the forward market is non-existent or severely restricted. 3. Forward hedging. This refers to selling the exposure currency forward against the base currency for sales and future inflows, and the opposite for purchases and outflows. This is normally the most cost-efficient and effective way to hedge FX risk and is described in more detail below. 4. Option hedging. This means hedging the FX exposure using FX options. It is not uncommon in commercial businesses to hedge special situations such as bids and tenders where the FX exposure is material but uncertain. For normal FX exposures and assuming no view of FX rate movements, see unknowable future section above, options will always be more expensive than forwards over time because the option buyer pays a premium for the flexibility they do not use if they have no market view. 4. Monitor FX risks, daily mark-to-market to ensure that hedging works as intended and risk limits are not exceeded. After hedging the FX exposures, treasurers continuously monitor the net FX exposures on the basis set out in their FX policy, which will normally include some combination of 1. Nominal exposure, 2. Mark-to-market, 3. Value at risk, VaR, and 4. Stress testing. This will normally be automated by the Treasury Management System and trading systems, which will continuously, near real-time, or at least daily recalculate these metrics using current market rates and flag any limit breaches or other exceptions. Foreign currency risk management tools. Are you an importer or a business that makes regular overseas payments in a foreign currency? If so, you are probably already aware that currency fluctuations can greatly impact your bottom line. Getting the right protection from adverse currency fluctuation is one of the most important steps any business dealing in international trade can take. When margins are already tight for so many, falling foul of exchange rate volatility can mean profits are lost or in extreme cases, the end for a struggling business. Unless specified when buying foreign currency, the conversion will be dictated by the rate at the time and day of purchase. Do not let adverse currency movements take their toll on your business. Currency risk can be reduced by hedging, which offsets currency fluctuations. Here are 6 valuable currency risk management tools that can be engaged by a firm to protect its business from volatile exchange rates and enhance its competitive advantage. 1. Forward exchange contracts. A forward exchange contract is a binding agreement to sell, deliver, or buy an agreed amount of currency at a specified time in the future at an agreed exchange rate, the forward rate. A forward contract eliminates the risk of exchange rate fluctuation by allowing the user to hedge expected foreign currency transactions by locking in a price today for a transaction that will take place in the future. For importers and those paying overseas suppliers, predicting and projecting future cash flow can eliminate uncertainty when doing business abroad. Forward contracts can usually be fixed for up to a year and give companies greater reassurance that if exchange rates change unfavorably, profit margins will not be negatively affected. There is also the added security of transparency, as businesses will also know the exact sums involved when dealing with overseas suppliers. Let us assume that an Irish importer purchases an item from a UK supplier in pounds sterling with payment due in 30 days. She can wait to see what the euro to pound sterling rate will be on that date, or she can lock in the current rate with a forward contract. When payment is due, she can simply contact her payment solution provider to pay the sterling proceeds of the contract to the supplier. The fixed rate now protects the importer from the potential for a sharp move against her when she makes the payment. 2. Currency futures. Simply think of these as items you can buy and sell on the futures market and whose price will closely follow the exchange rate. Let us say that a US exporter is expecting to receive 5 million euros in 3 months' time and that the current exchange rate is US $1.24. Assume that this rate is also the price of US $/euro futures. The US exporter will fear that the exchange rate will weaken over the 3 months, say to US $1.10, that is fewer dollars for a euro. If that happened, then the market price of the future would decline to around 1.1. The exporter could arrange to make a compensating profit on buying and selling futures, sell now at 1.24 and buy later at 1.10. Therefore, any loss made on the main currency transaction is offset by the profit made on the futures contract. This approach allows hedging to be carried out using a market mechanism rather than entering into the individually tailored contracts that the forward contracts and money market hedges require. 3. Options. Options are radically different. They give the holder the right, but not the obligation, to buy or sell a given amount of currency at a fixed exchange rate, the exercise price, in the future. If you remember, forward contracts were binding. The right to sell a currency at a set rate is a put option. Think, you put something up for sale. The right to buy the currency at a set rate is a call option. Suppose a UK exporter is expecting to be paid $1 million for a piece of machinery to be delivered in 90 days. If the pound strengthens against the US dollar, the UK firm will lose money, as it will receive fewer pound for the $1 million. However, if the pound weakens against the US dollar, then the UK company will gain additional money. Say that the current rate is US $/pound 1.40 and that the exporter will get particularly concerned if the rate moved beyond US $/pound 1.50. The company can buy pound call options at an exercise price of US $/pound equals 1.50, giving it the right to buy pound at US 1.50/pound. If the dollar weakens beyond US $/pound 1.50, the company can exercise the option, thereby guaranteeing at least £666,667. If the US dollar stays stronger, or even strengthens to, say, US $/pound 1.20, the company can let the option lapse, ignore it, and convert at 1.20, to give £833,333. This seems too good to be true, as the exporter is insulated from large losses but can still make gains. But there is nothing for nothing in the world of finance, and to buy the options the exporter has to pay an upfront, non-returnable premium. Options can be regarded just like an insurance policy on your house. If your house does not burn down, you do not call on the insurance, but neither do you get the premium back. If there is a disaster, the insurance should prevent massive losses. Options are also useful if you are not sure about a cash flow. For example, say you are bidding for a contract with a foreign customer. You don't know if you will win or not, so do not know if you will have foreign earnings, but want to make sure that your bid price will not be eroded by currency movements. In those circumstances, an option can be taken out and used if necessary, or ignored if you do not win the contract or currency movements are favorable. 4. Limit orders. A limit order can be used to set the ideal exchange rate at which to buy a particular currency. This is a favored strategy when current market rates are less favorable for currency buyers. They are highly favored by businesses that need to make payments but are not confined to deadlines. For example, if the current rate of exchange is €1 equals 87 pence, a business owner may not want to send £20,000 to the UK until he can get a better rate. He then makes a limit order to his payment provider targeting a rate of €1 equals 90 pence. When this rate is reached 4 months later, the transfer is triggered and funds are sent to the UK. This is particularly useful when payment deadlines do not have to be fulfilled. Once the rate is achieved, businesses can be assured that the payment is made just at the right moment. Clients will make such orders with their payment providers in order to monitor currency market movements when they themselves are not able to do so. This can happen following overnight market sessions when volatility may have occurred and the impact on rates may otherwise be lost if not monitored. 5. Stop-loss orders. Stop-loss orders are used by business to lock in a deal so that it never trades below what it deems to be an acceptable exchange rate. This effectively guarantees a minimum rate at which the currency is exchanged. It is an instruction to buy or sell currency at a predetermined worst-case exchange rate. Stop-loss orders are often used when there is negative sentiment about currency movements and the risk to exposure of such movements can then be reduced. It should be noted also when locking in an exchange rate that a company could miss out if currency movements go in its favor. However, normal trading businesses should avoid taking a speculative position, either deliberately or through inertia, because this can be very costly. 6. Foreign currency bank accounts and loan facilities. These alternative methods of managing foreign exchange risk can be used when the timing of the foreign currency inflows and outflows do not match. The timing issues can be managed by depositing surplus foreign currency in a foreign currency account for later use, or by borrowing a foreign currency to pay for foreign currency purchases, and then using the foreign currency to repay the loan. Conclusion. This video has discussed the meaning of foreign exchange risk and how to manage foreign exchange risk. It discussed the meaning of currency risk and the management of currency risk. Foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuations. Foreign exchange risk can also affect investors, who trade in international markets, and businesses engaged in the import/export of products or services to multiple countries. The 3 types of foreign exchange risk are transaction, translation, and economic risks. Hope the video is educative and beneficial to you. Which aspect of foreign exchange risk management discussed in this video do you consider to be most crucial in business organizations? Please post your answer to this question in the comment section below. If this video has been helpful and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for watching the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, please subscribe to our channel, Risk Management of Everything, and press the notification button so you can be notified when we upload new videos. Thank you.